Chapter 4 is going to focus around all of the strategies discussed in trading tickers and how useful they are in current market conditions. As you'll recall from trading tickers, there were 8 strategies we discussed in that course: buying new stock promotions, OTC multi-day breakouts, OTC shorting, buying major multi-day breakouts on listed stocks, shorting parabolic spikes, shorting into major resistance, overextended gap down shorts, and shorting into bounces. Let's start off by tackling the OTC strategies. One criticism I see a lot when people discuss trading tickers now is they say that the OTC strategies are no longer useful. That is a point that I will concede only for the chapter on buying new stock promotions. It really was a case of unfortunate timing. Up until the point trading tickers was released, we'd been going through a cycle where promoters, they would rise, they would get shut down, they would fall, and then new ones would surface. Even though things did seem to be slowing down a bit with the disappearance of best damn penny stocks and awesome penny stocks, stock tips was still around, and there really was no reason to believe that another major promoter wouldn't step up and things would continue as they had been. Unfortunately, stock tips really was one of the last big ones that we ever saw. Stock tips may have had one more promotion that they released after trading tickers came out. I don't believe it did all that much that was impressive. And then they were done. They were shut down as well. They might have, I think, spun off into some weird sub-penny pump site, but I don't think it was the original people behind stock tips. I think that someone just bought their email list from them and then tried to pump sub-pennies. Point is, they were the last of the giants. And once they were gone, OTC new promotions, they became pretty much worthless. There was nobody generating that huge volume. There was no opportunity to buy and sell into a quick, predictable spike. So yeah, that sector completely died off. It actually made me really grateful that I had decided to start branching out into NASDAQs, because that was one of my biggest setups gone, just like that. Now, that is a rather negative way to start this chapter, saying, oh man, this setup's worthless now. But the good news is that's the only setup I feel that way about. I think that the assessment that the OTC market is dead is really ludicrous, to be honest. The OTC market, it always has been fairly cyclical. There will be very active months and very quiet months. But the times where it's active, the times where there's a hot sector, man, is there opportunity. So OTC multi-day breakouts, yeah, I absolutely still play them when the opportunity arises. If anything has changed in my trading of OTC multi-day breakouts, it is that I'm looking for more liquidity. It goes back to what we talked about a bit in chapter 2, where I'm looking for a little more volume on OTC stocks so they're less of a headache. So I'm playing only the most liquid OTC multi-day breakouts. Do they all work? No, because no setup is ever going to work 100% of the time. But even just this year, I've had some really nice wins on OTC multi-day breakouts. For example, this TLSS multi-day breakout passed the 10-cent area. I was long this with quite a bit of size, and my sells, despite being a bit early, still netted me a pretty nice gain on the trade. I think I might have been 40 or 50K. And part of what made this possible, the volume that TLSS was trading. On the day of its breakout, 145 million shares traded. I did gap it into the next day, over 100 million shares on the next day as well. Another OTC I tried trading some breakouts on was CYDY this year. Now, unfortunately, I didn't buy the huge breakout that really sent a parabolic from the $4 area up to the $10 area, but I did buy some breakouts earlier in the pattern. Some of them were small gains, some of them were small losses. It did have numerous breakouts over the course of its run. I mean, it ran for months. It's not one that really amounted to anything too large on the long side, but just another example of an OTC where the liquidity was there to try to trade it. Another big OTC breakout trade for me this year, DECN. I bought it on the multi-day breakout past the 31-cent area. It traded over 80 million shares that day. I sold it into the gap up and spike the next day, or at least most of it. I believe I got caught some of it into the panic when the candle went pretty much straight down from 40 cents to the low 20s. One of the fastest collapses I've ever seen on day 2 of a breakout. Thankfully, I was out most of my size by the time it happened. The point is, these opportunities do still arise. I do still watch my OTC scanners. I do keep tabs on multi-day charts. I set price alerts. I am there and I am waiting and I'm following the rules of trading tickers when I see this setup form. I may be just a little bit pickier about which ones I play. The exact same could be said about OTC shorts. I'm still trying to trade them when I see that great daily chart extension. Maybe I'm a little bit pickier on liquidity, but I still probably prefer shorting OTCs to listed stocks, even though fills can be a bit of a headache. The panics can just be so quick and so large compared to the choppy downtrends that listed stocks have that can present all kinds of headaches. Touching back on CYDY, which we just talked about, I may not have had much luck on the long side playing breakouts on this thing, but on the short side, I had the best trade of my career. I totally understand the frustration if the setups don't come around as often as you'd like. Trust me, I'm in the same boat. I wish that there were 5 big runners every day. But with the OTCs, it really is just a matter of staying patient, and when the opportunity arises, be ready to strike. So for the OTC breakout, for the OTC shorts, overall, I'm playing the same rules I talked about in trading tickers. If anything, just a little bit more selective on liquidity, but that's all I have to say about them. When the setup is there, I am ready. Moving on to listed stocks, let's talk about buying multi-day breakouts for those. Over the past 5 years, I would have to say that buying listed breakouts has been my most profitable long strategy. They certainly can be frustrating at times, there definitely can be failures, but the ones that work, they sure are fun. I still do my very best with these plays not to let myself get shaken out into random weakness. I'm trying to follow the overall trend, I'm trying to pay attention to key supports, and if the trend is holding, it's gonna take a lot to shake me from my position. I really do my best to sit on my hands and not get bored. The success of this setup, it does kind of ebb and flow with the market. It tends to do best when you do see sectors heat up. There are probably a couple things worth noting that have changed with how I approach my multi-day breakouts for listed stocks. The first is I do think more about share count now. The lower the share count, the better. I want there to be a lower market cap on the stock. It is my opinion that that gives the stock a better chance to squeeze if there is less of a share supply overhead. When I'm looking at market caps for listed breakouts, I'm generally looking at $500 million or less, although there are some random exceptions that I'll make where I do trade breakouts that are more in the realm of $1 billion for the market cap. For those examples though, the stock usually is trading very, very high volume, to the point that I feel the volume can overcome the large share count. Another change would be that I'm probably a lot more cautious about trading the early morning multi-day breakouts. There's just so much volatility early morning and so many large gappers that can gap up near a breakout level. I'd much rather see the stock consolidate for a while, hold up, prove itself, and then buy on a high of daybreak later. Early morning to me just means greater chance of failure. Now, how do I define early morning? I would say any breakout before 9:45 a.m. Eastern time. That does include pre-market. I'm not buying a breakout pre-market as it gaps through. So if I'm going to look to strike on a daily chart right as a multi-day level is breaking, it needs to be after 9:45. If I miss, so be it. It's okay if some run without me. And just to give you an example of what I'm talking about with these early morning breakouts, let me show you THMO. THMO is an example where the stock did gap up quite large. It was opening near its multi-day breakout level, but ultimately it put in a red daily candle. It was a failure. Here you can see the intraday chart as well. This is exactly the kind of thing that I'm trying to avoid. Rather than buying a break past that multi-day level in the first minute or two of market action, I'm going to sit on my hands, I'm going to stay out of the way, and I'm going to let the stock pick which way it's going. If it can consolidate and come back and break past 878, that is the break I will look to buy instead. But the choppy early morning action, I want no part of it. The rest of the strategies discussed in trading tickers revolved around short strategies for listed stocks, and this is now what I really want to get into and review much more in depth. The remainder of this chapter is actually going to be entirely focused on these short strategies and one major change that I made that applies to all of them. We will be sure to note any minor changes that may have taken place in each individual strategy as well, though. The major change that I feel it is absolutely imperative to revisit is the way I was handling my risk management for these shorts. Yes, in chapter 1, we already talked a lot about the golden rule, about stubbornness, about adding outside of risk. That's not what I'm referring to here. This is an entirely different problem that I had in my risk management, one that it took me quite a while to be able to identify. If you'll recall a lot of my trade examples on the shorts from trading tickers, I would often be in a situation where as long as the stock was within my risk, I was okay adding as it went against me. In fact, that was a big part of my strategy. There are a few trades in particular that when I rewatch, I really kind of cringe at because I'm talking about how I'm willing to add up to a certain number of shares as it goes against me. Now, on the surface, this seems okay. It's part of the plan from the start. The stock is within my risk. I'm not in a stubborn situation. So what is the issue? The issue is that I started to notice a pattern in my trading. That pattern is that I would very often find myself on the stocks that worked out absolutely perfectly, only having about quarter size, maybe half size best case scenario. But the losers, assuming I didn't get stubborn, I didn't add too much, they seemed like they were always full size still. I think part of the reason this was so hard for me to see is because on a lot of these trades, I was getting decent risk reward. So in a lot of cases, a half size win would still be about the same or even slightly more profitable than a full size loss because the risk reward was so in my favor. But that didn't change the fact that I was not getting a full position on the winners, and I couldn't figure out how to deal with this problem. The first thing I really had to figure out was why was this problem even happening in the first place? It really did boil down to the strategy that I was taking for my entries. The idea of add a quarter, add another quarter, add another quarter as it goes against me, it was a setup for failure. Think about it. We'll take an overextended gap down, for example. If I see that perfect overextended gap down chart, the mentality I was going into the trade with was, oh, well, I want my average entry to be as good as possible. How do I ensure this? What if the stock spikes a little bit after the gap down? The solution in my mind was just giving myself the flexibility for that add approach. The problem is not all overextended gap downs have morning spikes. Even more of a problem, the ones that did have spikes would spike to a varying degree. Some would come up all the way to red, green, and test it. Some maybe would only pop a few percent before fading off the rest of the day. I really did not have a good feel for my plan at all because in each overextended gap down, I really didn't have a sense of how much it might spike before fading off like I expected to. The big picture setup, I had a good feel for. I thought I knew what I was going to do all day. I was usually right that I would be looking at a most of the day fade. My problem was in that first 15 to 30 minutes of action, trying to figure out that smaller scale. And rather than just worrying about that big picture and trusting the overall daily setup to work out in my favor, I was aiming for perfection on the small scale. And I may be using overextended gap downs as an example here, but like I said, this really applies to every single short strategy that I was trying to trade. Whether it was a short into resistance, a bounce short, it really didn't matter. The problem was that I was so worried about trying to get the best average possible that I was taking this sloppy entry as my strategy. So quite often, here's the situation I would find myself in. Situation 1, which probably happened more often than not, would be that the play would just have a small little spike up. I would get my initial quarter size, half size, something like that, and then it would fade off as planned. It would be a pretty stress-free winner. These stocks that only spiked a little bit, that'd be about the limit then because of my plan. If I'm planning to add in pieces as it gets closer and closer to my risk level, if it doesn't get all that close to my risk level, there's never an opportunity to get beyond that half size. Situation 2 would be the ones where it did get all the way up to my risk level, the spike, went up there, it tested it, but still would fail. These would be the rare examples where I would get full size on my short because I was building short into that spike, and then everything would be okay in the end because I didn't get stopped out. Then, of course, there's situation 3. And situation 3 pretty much guaranteed a full size loser every time because if the plan is add as it goes against you, as it gets close to testing risk, well, a stock that stops you out, it is going to go right up and test risk. It's inevitable. So every one of these situations, I'm getting every single add that I had planned on, and then I'm getting stopped out. So it was very, very clear to me once I identified this problem that I had to change how I take my entries on these shorts. The strategies themselves, they're great strategies. They're absolutely fine. But this terrible, terrible entry method was really causing me problems. So how do I deal with this now? I have taken the pressure off of myself. I am not trying to be as perfect as possible. I'm watching the action. I'm still trying to be smart. I'm still trying to time things decently. But when I want my entry, I'm taking it all at once. I'm going to put on my full-size risk pretty much in one shot every single time. No more of this add garbage, at least not when it's going against me. Now, when I made this change, the biggest thing that my mind kept jumping to, the thing I was the most concerned about was, oh, but what if I don't catch the top? What if I mistime it a little bit? Because obviously the closer to the risk I enter, the greater number of shares I would be able to take. And sure, there definitely will be times where I mistime things a little bit. But I've embraced the mentality that it's better to be a little too late rather than a little too early. To help my timing, I'm not just randomly stabbing into a spike along the way, taking all my size at once as the stock is still showing strength. I'm trying to wait for a crack, I'm trying to wait for some sign of weakness, and then I'm going after a bounce after that, playing off of whatever I think the most key risk level is, or the most appropriate for the situation. But this way the stock, it has its chance to put its spike in. Whether it's just a really small spike, whether it's a large spike all the way up to the risk level, I'm going to watch it, I'm going to analyze it, and as soon as I think I'm seeing the short-term spike weakening, I think I see the backside, that's when I'll strike. Overall, I think it has helped improve my timing, although there will still be times that I'm wrong and I mistime it. But I am still so much more profitable doing it like this and mistiming it every now and then than I was when I was only getting half size on my winners and full size on my losers. In this case, I have my full dollar risk on in every single position, winner or loser. It's just up to me as a trader to try to be as precise as possible when taking that entry. But then, right or wrong, no matter how well I time it, I'm gonna live with it. I'm gonna take my one-shot entry, and I'm gonna trust the big picture to work out in my favor. If I get stopped out, that's fine, that's trading. But at least now I'm full size in both situations. One thing that kind of goes hand in hand with this change that I'm talking about, I said I'm not adding anymore when the position is going against me. However, I will add to winners now. I'm trying to be more aggressive about that. That is something I've worked on a lot. I get asked a lot, how do I decide when to add to a winner? For me, it really boils down to one of two things. The first thing I would probably consider is, did I get full size in the first place? The answer to this is almost always yes, unless I just struggled getting a fill or something like that. But the second more important thing would be, is there a new risk level I can use? Or I suppose, has my confidence in the setup greatly increased to the point that I'm willing to take on a slightly larger risk position? So just to try to articulate a little bit better what I'm saying here, if I short a stock and I'm originally risking the $1 level, let's say, and I got full size off of that $1 level, if the stock is now fading, if it's going in my favor, and I think I see a new top forming, I think I see a very clear resistance area at, let's say, 90 cents now, well, I might consider adding to my position in a bounce if I feel comfortable using 90 cents as my risk now instead of the $1 mark. It's important to me to be able to move that risk level, though, because that's how I keep my dollar risk from getting out of control. So if I was risking, let's say, $10,000 on the $1 risk level in the first place, if now I feel like I can use 90 cents as my risk level, I'm going to add as many shares as I can at whatever price I'm trying to add to get my risk back to that full $10,000. Only difference is now that I'm playing off of 90 instead of $1. The other scenario I briefly touched on is if my confidence in the setup is just so high that I say, you know what, I'm willing to have a little more money on the line. This is a bit riskier, something I don't do as often, but there are times where I will get my short, I'll have my $10,000 risk, let's say, the stock will make some kind of move that makes me think with very high certainty that the stock is broken, that it's not gonna come back, that I'm very safe, and then maybe I will put on ads using the same risk level, but now my total dollar risk will be more like 15,000 or 20,000. Like I said, a bit riskier, because there are still times where that high confidence, it may blow up in my face. I may shoot myself in the foot and then have to eat a larger loss than I'd like because of my aggressive ads. From time to time I'll do this, but it's not too frequent. The biggest mental hurdle for me with adding to winners is feeling like I'm ruining my average. So going back to the hypothetical we were talking about where I'm using $1 as a risk level on a short, maybe my average is 97 cents or something really good, really close to risk. It can be hard for me to put an ad on, let's say in the 80s or something like that, and then all of a sudden have an average down more in the low 90s. Rather than focus on what is the overall average of my position, I really do try to keep my focus instead on what is the overall dollar risk. That's the only way I've really been able to deal with that mental hurdle, because you do hear other traders also say it a lot. They didn't want to ruin their average. Well, I've gone through that too. It is tough. But in my opinion, it's not where my focus should be. Just ensuring that I'm adding the right number of shares so that my dollar risk doesn't spiral out of control, focusing on that, and focusing on my new risk level, that's really all I feel I need to pay attention to. Adding to winners with this mentality has definitely helped some of my winners get much larger than they otherwise would have been. So what I want to do now is I want to jump into some live trade examples, just a couple from each chapter of Trading Tickers that focused around shorts, and I want to show myself trading these setups with these new risk rules in mind. I think it's a really important difference for everyone to be able to see it. We'll go ahead and take it one setup at a time and make sure I also take the time to note any differences in each setup, but hopefully this is beneficial both as a bit of a refresher to the Trading Ticker strategies, as well as seeing the improvements that I have made that have helped accelerate my profitability. The first example that we'll get into is a bounce short, and I can say that bounce shorts, it's probably the most straightforward one since Trading Tickers. Almost nothing has changed at all. I'm still looking for a key resistance level to short off of. I just want that significant risk level to align on multiple time frames, meaning that if I'm looking at a 1-minute chart, 2-minute chart, 5-minute chart, it's going to be an obvious risk point on all of those. So let's go ahead and just jump right into a bounce short example. The bounce short we're going to take a look at is mRNA, a stock that is definitely more expensive than I typically play, but I still thought it was a solid bounce short opportunity nonetheless. mRNA had a huge panic from a high of 56 down into the low 40s, followed by a nice large bounce. And now this is the first time I think that I've seen the bounce weakening. It's up quite a bit off of its lows, it's approaching the area that I would want to be my risk level, the red-green line, and it's had a few dollar pullback off 50 cents. So now that I think that I'm starting to see the backside of this bounce, this is the push that I'm going after, and you can see that I've entered my 3,000 share short order. I'm going to be risking off of red-green with this short, like I said, and now my shares, they are starting to fill, and I have my full 3,000 shares short. Now, ideally, now that I have this position, what I'm hoping this will do is it will top out near 50 again, or even fail a little bit lower, and then I could potentially add into a winner into further bounces and move my risk down to the 50 area, which also aligns decently with VWAP, rather than having to continue to risk off of red-green. So far, feeling pretty good about my short. I've got a 48.60 average. I am slightly down right now, just about 10 cents a share at the moment, no big deal. And this choppiness, I really try not to let it scare me out. And because it's only midday, we're really speeding up the action here. Rather than live and die with every little push up, every little pull back, I'm not going to be freaking out about any of these little moves. There's really just a couple of points that matter to me. My risk level, and also I'm just looking to where I might want to cover. I don't think there's very high odds that this would fade all the way to new lows and crack the low a day, but any fade down near low a day, I'd probably consider paying myself. So maybe the 44 area, 45 area, those are potential profit areas for me. The low on the day currently is 43.11. We did have a little further pullback there and then another pop. This is a potential area I could have added, but I often try not to be too quick about moving my risk down. It hasn't even been an hour since that high was set in the 50 area, so still just a bit soon for me. So I don't want to be too aggressive, and I don't put on any ads here. I'm just keeping the wider risk, keeping myself comfortable. Still just quite a bit of choppiness. Overall, sideways action, and now we start to perk up a bit. So now this is where if we do see the 50 area fail a second time and then there's a hard crack off of the 50 area, then I would feel a lot better about making 50 my risk, because then rather than just one failure up there, we'd have two. But I still need to see that sign of weakness. That tiny little pullback off of that attempt was not nearly enough for me. Still further grinding action up into VWAP. $50 is still holding as a top pretty well. I just need some kind of hard slam. We have perked through 50 a couple times, but never with much strength. It has slapped right back under each time so far. But now this perk is starting to get a little bit scarier. This is a spot where emotions, they do start to kick in. Now we're testing 51. I'm not feeling great about this at all, but I am respecting my stop. I do not want to stop out into random strength when I don't necessarily feel like my risk level has been broken. Even if I'm starting to feel like, oh man, maybe this isn't going to work out, I try to stick to my risk. I'd so much rather lose at my risk level than just below it. And that test of red-green, it failed the first time. We are slapping back. It is barely under 50 here. But now the opportunity to move my risk down, that's pretty much gone, because that was a higher high. So I'm going to have to keep red-green as my risk. This is not going to be a situation where I can likely add to a winner. One thing I possibly could do is use this pull as an exit and just take off the trade for a roughly break even or even a small loss, but I'm not convinced it's going to go against me yet. My risk held. This little pushback into VWAP here very easily could fail, and then we could keep on trickling off into the close. So I'm trying to sit back and just stay patient. I'm sized in appropriately. 3,000 shares at 48.60, risking off of 51.69, assuming a little slippage, that's going to come in right at my $10,000 loss. That's how I remain so calm in these situations, because this is not a scary situation. This is normal size. If I'm wrong, I am wrong. So I'm just trying to wait out this choppiness and hopefully get some fade into the close. But at this point, this certainly has not been an ideal play at all. Way too much choppiness and more strength than I would have liked to see. Another perk towards red-green, another failure. If I don't get stopped out, this is a situation that I would consider swinging into the next morning. Potentially a first red day on what looks like a pretty extended daily chart. It's not at all uncommon to see a gap down and more fade into the next day after first red day. The weaker it closes, the more comfortable I would be with that swing idea. If it does close up near red-green, my plan in this moment was just to take it off at the close for the loss, because it is a more expensive stock. That does kind of take it out of my wheelhouse a little bit. So what the chart does here in the last half hour, that's really going to dictate my overnight plan, whether I give this more patience or I'm just done. More battling around the 50 area. Starting to perk up again a bit. It really is not looking like I'm going to get my crack and weak close. And right there, I stop out. It did perk green just barely there. I respected my stop. I took it off just like I should have. Excuse that action on the screen. I had to get my realized profits to show. And you can see that I did lose just under $10,000. So yes, we are starting this DVD with a loss, but it was not an extraordinary loss whatsoever. This was very standard. Focus on how I stuck to my plan. I respected my risk. I cut it instantly when it was stopping me out. And although I was disappointed with the results, I felt good about my process, despite the fact that the last few minutes of the day, it actually did fade back under 50 again. So I did get tricked out a bit, I guess. I would so much rather get tricked, though, than put myself in a potentially stubborn situation. mRNA, it's the only bounce short we're going to look at. As you can see, things are very similar to how they were in trading tickers. No need to go more into bounces, but you did get to see at least one example where, rather than trying to add along the way into a bounce, I'm just taking my entry all at once. Full size if I win, full size if I lose. That's how I want my trading to be. The next setup